Lead, Manage, and Thrive podcast, mastering business, coaching, and growth, one story at a time. I'm your host, Joe Carter. Today, we're diving deep into private equity due diligence, and I mean very deep. I've lived on both sides of the table. I've been the owner, pouring everything into a business, and I've been the guy across the table, deciding what that business was really worth. After a decade in corporate, I leaped into franchise ownership. I wore every hat, fought for every customer, and eventually sold. That exit hit 7 times EBITDA, double the industry average. On paper, it was a huge win, but here's the catch. It also taught me a brutal lesson. Buyers didn't care about my grind. They cared about systems, margins, and whether the business could run without me. I left money on the table because too much of that value lived inside my head, not in documented processes. So I doubled down. I built differently. That next exit hit over 14 times EBITDA, a 9-figure win for myself and my partnership group. But even then, I later discovered the $3.8 million value gap that I hadn't seen until I worked inside private equity. That was a gut punch, realizing that I had left value behind again. Millions gone because the systems were not fully documented and vetted. That moment lit a fire in me. It stopped being about my exits. It became about helping other founders avoid that same regret. Inside private equity, I sat through over 400 due diligence reviews on deals that were worth more than $14 billion in business valuation. I've seen how one missing process can knock millions of dollars off of an offer, or how a documented system can add multiple turns to your valuation overnight. I want to start with a story, a real one. A few years back, I sat down with a founder who was gearing up to sell. Let's call him Ryan. Ryan ran a $6.7 million service business, a solid team with decent margins, and was growing steadily. The private equity firm came knocking. They offered an LOI that looked good on paper. Mid-7 figures, a solid multiplier, and some post-close upside. Ryan asked me to help him prep for that diligence. We cracked open the books, and within minutes, I'm talking 3, maybe 4 minutes, I saw the problem. Customer contracts, they were month to month. There was no stickiness. Churn was masked by re-signs. There was no net growth. Payroll had ballooned. There was no control. But the real killer, his reported EBITDA wasn't clean. They had buried owner comp in admin, capitalized some recurring expenses, and called a one-time windfall recurring. I looked at him in the eye and said, "You're about to lose $2 million in valuation unless we fix this fast." He paused and said, "Well, we've made it this far without SOPs or audits. I think we'll be okay." Spoiler alert, they weren't. The PE firm slashed their offer 60 days later. Not because Ryan was a bad founder, but because the business wasn't packaged to transfer value. That's the difference. You can build a company that supports your lifestyle, or you can build a company that someone else is willing to buy. This episode is about that second path, because if you've ever thought, "I'll deal with that stuff when I'm ready to sell," you're already too late. Here at the Twin Flame Group, we help founders turn revenue into transferable value, because that's the only kind of growth that matters when it's time to exit. This is a teaching episode, a masterclass, a wake-up call. If you're scaling past $3 million, if you've ever had your first intro call with a managing director from a fund, or even if you're just starting to think about exit strategy, this episode is for you. And I promise you, it's not just about paperwork. Here's what we're going to uncover: what private equity firms actually want in due diligence. Spoiler, it's not perfection, it's predictability. We'll go through the 4 core categories of diligence and how to dominate each one. We'll talk about what a top-tier exit actually looks like and why most founders leave chips on the table. Plus, I'm sharing real founder stories, the painful mistakes that cost millions of dollars, and the smart systems that have added 7 figures to the check. So pour your coffee, grab a notepad, because what you do before due diligence starts will either make or break the deal. So let's get into it. Before we go any further, I do have to set something straight. You're not just selling a business. You are selling a financial instrument, a machine with risk, returns, and levers. And private equity buyers, they are professional machine buyers. Their job is literally to find underpriced, under-optimized businesses and make them outperform. So if you don't understand the game that they are playing, you can never win it. Let me break this down. There are 2 primary types of buyers in the M&A world. There are strategic buyers. Think competitors, suppliers, and partners. Someone inside your industry who wants to expand their footprint. And then there's private equity. They're not buying a company to run it. They're buying it to grow it, optimize, and exit it. Strategics want synergy. PE wants structure. A strategic might overpay you if you have tech, market share, or customers that they need. A PE firm will only pay top dollar if they believe they can scale it and resell it later. The general time frame for them is 3 to 7 years. Now here's the mistake that I see founders make all the time. They think that PE is just another buyer. It's not. A strategic buyer might skip some diligence. They already know the market. They may already understand your cost structure. But private equity, they don't know you. They don't know your team. They don't know your product. So they have to rely on the process, on data, on diligence. If you can't show it, it doesn't exist. If you can't document it, they won't pay for it. Let me make this real with a story. A founder that I worked with was running a killer HVAC business. $9 million in annual revenue, over 22% margin, and was extremely attractive on paper. PE came knocking. They got an LOI fast, with a good multiple and a clean deal. But during diligence, they found that they didn't have consistent customer renewal processes. There was no CRM data to support retention claims, and no tracking on technician performance. So the firm pulled back. They didn't lose the deal, but the multiple, it dropped. That was over $1.8 million that were left on the table. Why? Not because the business was weak, but because it couldn't prove how strong it really was. Here's the kicker. PE firms do not get paid for buying great businesses. They get paid for buying businesses that can become great under their model. That means that they are looking for a few key things. De-risked operations, where the company runs on systems, not just on the founder. Scalability, where there's room to grow with minimal friction. Predictable cash flow, so that they can model their returns, service debt, and create value. And exit optionality, where they can sell it to another PE firm, a strategic firm, or an IPO. And they figure all of that out during due diligence. Remember this, PE is not just another buyer. They are the investor. They think in IRR, not in vision boards. They care about your team, your numbers, your stickiness, and your downside risk. So when I say understand the game, I mean this. If you want a top-tier exit, you have to think like a fund before they show up. Start speaking their language. Understand terms like EBITDA add-backs, working capital peg, and rollover equity. Know how earnouts work, how reps and warranties can shift risk, and how quality of earnings can either make or break your valuation. Because if you wait until the LOI to figure this stuff out, it's already too late. The most successful exits that I have seen, they're the ones where the founder was already running the business like a PE-backed company before the first call was ever made. They had clean books, quarterly board decks, performance dashboards, documented SOPs, a future-looking strategy. One founder even had a deck prepared for the buyer's buyer. Now that's next level. So the question for you is, are you building a business that you want to run? Or are you looking to build something that someone else is excited to buy? Because those are not the same thing. Let's move into the 4 diligence categories that separate average exits from elite ones. If you're still with me, you already know diligence isn't about impressing a buyer. It's about proving your business is built to last, scale, and sell. Private equity firms use diligence like a microscope and a stress test rolled into one. They're looking for red flags, but they're also looking for fuel, value that they can amplify. Let's walk through what I call the 4 dimensions of diligence. If you miss one of these, you are leaving money on the table. If you nail all 4 and you become what I call a franchise grade asset, that is a business that buyers will chase. Dimension number 1, financials. This is one that most founders think they are ready for, but most truthfully aren't. You need clean books, not cleanish, clean. Here's the checklist. Accrual accounting, not cash. 3 years of audited or at least reviewed financials. Normalized EBITDA with clear add-backs. Monthly financial statements that match your tax filings. A working capital analysis, because they will set a peg. Let me tell you about Olivia. Olivia ran a 7-figure e-commerce brand with high margins, a loyal customer base, and fast growth. But when we looked under the hood, the COGS were inconsistent. Inventory was managed in a spreadsheet. She lumped ad spend into general marketing. And when the PE firm brought in a quality of earnings team, they sliced $400,000 off of her adjusted EBITDA. Why? Because her numbers couldn't be tied to reality. That cost her over $2.5 million in valuation. So what's the lesson? Your numbers are your language. If they're fuzzy, then so is your value. Your action step here is to run your own internal Q of E. Hire a fractional CEO if you need to, but reconcile monthly. And track cash flow like your deal depends on it, because it does. Dimension number 2, operations. This is where deals get made. PE firms want to know, can this company run without the founder? If you vanish for 90 days, would the wheels fall off? That's not just a trust issue. That's a valuation issue. Operational diligence looks at just that. SOPs for every core function, tech stack and automations, performance dashboards, KPIs by department, team roles, and succession depth. A founder that I worked with, let's call him Mike, had an incredible logistics firm. Systems everywhere, routing software, margins dashboards, tiered service levels. When the PE firm walked through his ops review, they said, this runs like a portfolio company already. They added a half turn to the deal. That's $1.6 million, simply because of operational maturity. Don't overcomplicate this. Start with weekly team scorecards and quarterly reviews with defined KPIs, a single source of truth for performance. Operations is about reducing buyer anxiety because predictability equals premiums. Dimension number 3, legal and compliance. You don't need to be perfect, but you do need to be buttoned up. This is the graveyard of great deals because legal gaps trigger fear, and fear leads to discounts. Here's what they're checking. Are your contracts assignable? Is your IP actually yours? Do you have employee agreements, NDAs, and non-competes? Is there any ongoing litigation? Is your cap table clean and traceable? A founder that I advised had verbal agreements with 2 key suppliers, no contracts. They were handshake deals from 5 years previous. When the PE firm asked for supplier agreements, he had nothing. That alone didn't kill the deal, but it dragged it out for months, and it gave the buyer every excuse to negotiate down. Create a legal readiness file. Review it quarterly. Engage a transactional attorney now, not when you're already in LOI. And here's a bonus tip. Run a background check on yourself because the PE firm will. Make sure that there's nothing out there that catches them off guard. Dimension number 4, strategic narrative. This one's less obvious, but just as important. The strategic narrative is the story your numbers tell. It's your vision, your positioning, and your growth logic. Private equity doesn't just buy what is. They buy what could be, but only if the story is credible. Here's what they look for. Clear, defensible, total addressable market, or TAM. Sustainable, go-to-market motion. Repeatable acquisition channels. cohort data and churn analysis, and a clear path to margin expansion. A founder that I mentored had a brilliant pitch deck with a beautiful story. But when the buyer asked what happens to your LTV if your CAC raises by 20%, he blanked out. You need to pressure test your assumptions, build models, do sensitivity analysis, prepare for every skeptical question. Here's the power move. Tell a story that includes their exit. I had a client frame their business as a platform play. They laid out how the PE buyer could bolt on 3 adjacent brands, doubling their EBITDA and exiting at 10 times their investment in under 5 years. Guess what? That buyer came in at 15% over market value because narrative matters. So there you have it. Those are the 4 dimensions: financials, operations, legal and compliance, and finally, strategic narrative. Each one is a gate. You don't need to be perfect, but you do need to be prepared. Now we're going to jump into the traps that founders fall into and how to avoid sabotaging your own deal from the inside. I'm talking self-sabotage. Because here's the truth. Most deals don't fall apart because the buyer loses interest. They fall apart because the founder wasn't ready. Not financially, not emotionally, not even operationally. They step into diligence thinking that it's a formality. It's not. It's an X-ray. And what happens when you X-ray a body that has been duct taped together? You find breaks, gaps, and fractures. And it's the same in your business. So let's break down the top ways that founders sabotage their own exits and how you can avoid them. Sabotage move number 1, napkin math. You tell the buyer that you're doing 25% EBITDA, but you're not. You're adding back in your cousin's salary, your wife's leased BMW, the $40,000 event sponsorship that didn't convert, and the off-books contractor down in Miami. That's not a clean add back. That's wishful thinking. Buyers don't trust napkin math. And when they smell overinflation, they get cautious. Or worse, they walk. So to fix it, run a real adjusted EBITDA analysis. Use industry comps. Document every add back with backup. Sabotage move number 2. The "we'll get ready after LOI" lie. I've heard this too many times. We'll clean up the data room once we have a signed offer. That's the wrong move. By then, you're under exclusivity. Your leverage is gone. And every delay or red flag gives the buyer an excuse to retrade. I had a founder delay their Q of E until post LOI. The PE firm found 3 months of misclassified revenue. That one slip cost him $800,000 off the top. So fix it. Build the data room before the LOI. If a buyer asks for access tomorrow, could you click the send button? If not, then you're not ready. Sabotage move number 3. Founder dependency. You think that being the rainmaker, the ops brain, the finance guy, and the closer makes you valuable. It doesn't. It makes you a liability. One PE partner told me directly, if the founder can't take a 2-week vacation without the place stalling, I'm going to discount it hard. So fix it. Start delegating long before you plan to sell. Build a leadership team. Name a successor. Show that the business runs without you. Sabotage move number 4. Misreading the process. Founders often think that the deal is done when the LOI is signed. They start spinning the check in their head. But diligence is where real negotiation begins. Every document that you provide, every delay, every inconsistency, that is a negotiation point. And PE firms are experts at using that to their advantage. So fix it. Stay sharp until the wire transfer hits. Control the narrative. Preempt their questions. Stay one step ahead. Sabotage move number 5. Emotional reactivity diligence. Diligence can be intense, even personal. You're pulling back the curtain on something that you built from scratch. So when some 19-year-old associate questions your pricing model or wants to see Slack message logs from 3 years ago, it can be tempting to snap. Don't. Professionalism in diligence signals post-close maturity. If you get defensive, combative, or dismissive, buyers assume post-close chaos. So fix it. Play the long game. Let your team handle the grind. Keep your energy focused on alignment and vision. Look, deals don't die in diligence, but they do more often than you think. In the over 400 due diligence deals I had the opportunity to review, 200 got to LOI. Of those 200, only 14 closed. Most of those deaths, they were self-inflicted. Avoid these 5 traps and you massively increase your odds of closing at the valuation that you deserve. So I'm going to show you how to use our strategic growth blueprint to bulletproof your business and turn these weaknesses into valuation fuel. By now, you know what diligence demands. But how do you know and how do you operationalize that insight? How do you turn prep into leverage? That's where the strategic growth blueprint comes in. It's the system that we've used with hundreds of founders to engineer exits, attract capital, and grow companies that scale themselves. It's simple. 4 pillars. Number 1, clarity. Number 2, cadence. Number 3, conversion. And number 4, command. Let's walk through each one with a real founder story along the way. Number 1, clarity. Know what drives value. Most founders, they track revenue, but the great ones, they track valuation levers. Valuation comes down to 3 factors: predictability of earnings, scalability of operations, and transferability of systems. Clarity means knowing your top 3 drivers of EBITDA, not revenue. Knowing your customer LTV, knowing your churn, your CAC, and your margin floor. Example, one SaaS customer that we worked with thought that pricing was their top lever. But turns out it was expansion revenue from customer success. When we shifted strategy, they boosted their MRR by 28%, all without adding a single new logo. Clarity turns noise into signal. It focuses your team on what actually moves the needle. So here's the action step. Identify your top 3 value drivers. Then build dashboards around them. Next, cadence. Build a repeatable operating rhythm, because valuation doesn't come from chaos. It comes from consistency. Cadence is your operating rhythm. It's how you meet, report, and review. Here's what it should include: weekly leadership huddles with KPIs, monthly financial reviews, and quarterly board-style reviews, even if it's just you and an advisor. Why? Because when buyers see rhythm, they see maturity. One of our clients installed a simple 90-day cadence: plan, execute, and review. In 12 months, they doubled their EBITDA and ran a tighter business that many PE-backed companies did. So here's the action step. Install a leadership cadence. Have weekly ops check-ins, monthly financial reviews, and quarterly strategic resets. Third, conversion. Turn SOPs into value. Most founders think SOPs are for onboarding and training new employees. They're not. They're for valuation. When a buyer sees that every critical function is documented, repeatable, and owned by someone other than the founder, that is transferable value. One founder had 17 core processes that was documented in Notion: sales, onboarding, billing, renewals. He walked into diligence with a playbook. The buyer bumped his multiplier before QE was even done. Why? Because playbooks de-risk the deal. So here's your action step. Start with your biggest bottleneck. Document the 5 key steps, then assign it to an order, and repeat the next bottleneck. Finally, number 4, command. Lead like a portfolio company CEO. Here's the difference between a hustler and a CEO. One puts out fires. The other builds systems. Command means that you lead your business like it's already owned by a PE firm. Use data to make decisions. You manage by objective, not by emotion. You think in quarters, not in days. A founder that I coach moved from reactive to proactive leadership by installing a scorecard culture. Every department owned 3 metrics. Every week, the leader of that department reviewed the project with the entire team. Within 6 months, they had reduced customer churn by 19%, and the buyer noticed. So run your business like your board is watching, even if you're the only person on the board. So here's the full blueprint: clarity, know your levers; cadence, install your rhythm; conversion, systemized operations; and command, lead like you're already owned. This isn't theory. It's the difference between a 3 or 4x multiplier and a 10 or 15 one. Use the blueprint. Apply it relentlessly. And you'll not only survive diligence, you'll thrive in it. Now we're going to talk about how to prep like a pro, using real checklists and systems to get ahead of diligence before it ever starts. Here is the truth that no one tells founders: the deal starts before the deal starts. By the time you get the LOI, the valuation is already mostly baked in. The leverage is gone. It was either earned or lost months ago. So if you're serious about building a business that sells well, you need to prep like a pro. Let me walk you through the 5 core habits that separate the deals that close at full ask from the ones that get retraded, delayed, or derailed. Number 1, run a mock diligence quarterly. Think of this like a dry run before the big game. Grab a diligence checklist from ILPA, Invest Europe, or even our Twin Flame prep kit and go line by line. Can you produce customer contracts in under 5 minutes? Do you know your working capital position at quarter end? Are your org chart, employee agreements, and vendor terms current? Most founders treat diligence like it's a fire drill. The smart ones treat it like a dress rehearsal. And guess what? When you practice quarterly, the real thing, it just feels like another Tuesday. So schedule a quarterly internal diligence review. Use an external advisor if you want to stress test it. Now, number 2, build your data room now. Too many founders wait until the LOI to start gathering documents. That's a big mistake. By that point, you're already under exclusivity. You've lost your leverage. And every day of delay erodes buyer confidence. So start building your data room today, even if you're 12 months or more out. Here's what it should include. Financials that include your P&L, your balance sheet, and your cash flow analysis. Customer and vendor contracts. Corporate documents that should include your cap table, your bylaws, and your organizational chart. Your HR files that it should include contracts, benefits, and comp plans. Legal and compliance, including permits, insurance, and IP. Make them indexed, make them clean, make them impressive. And a pro tip, use a deal room platform because Dropbox won't cut it when the buyer gets serious. Now, number 3, weekly financial reviews. If you don't know your numbers cold, someone else will use them against you. Set a weekly rhythm. Review actuals versus forecast. Monitor burn and margin. Track KPI targets and anomalies. Why? Because financial surprises in diligence always cost you money. One founder that I worked with caught a margin dip in their weekly review 2 weeks before the PE firm did. They got ahead of it, fixed it, and it kept the deal clean. Finance is your scoreboard. Read your scoreboard every week. And number 4, clean contracts with clear KPIs. Every buyer will ask the same question. Can we trust what we are buying? If your customer agreements are outdated, vague, or non-binding, that's a problem. If your KPIs are inconsistent, undefined, or missing context, that's a bigger problem. You need assignable contracts with clear, renewable terms, vendor agreements with defined SLAs, KPI performance by department, and you need it all documented, stored, and explainable. Remember, clarity builds confidence, and confidence commands multipliers. Number 5, build your board muscle. Even if you're a solo founder, you need outside perspective. Get a board observer. Even better, build an advisory board with at least one person who has sold a company or done private equity deals. Why? Because they will help you to anticipate diligence questions, prepare board-style reporting, pressure test your strategy. And when the PE firms see that you've already been operating with board-level discipline, it signals maturity. It tells them this founder is ready for a capital partner. I once had a client who brought in a board chair 18 months pre-exit. That single move sharpened every meeting, tightened every metric, and prepped the team for a clean, no earnout close. It was textbook. So what's the play? Mock diligence every quarter. Data room, build it now. Weekly financial reviews, never miss one. Clean contracts plus KPIs. Document everything. And board level discipline. Practice before you are forced to. Prepping like a pro doesn't just protect your deal, it amplifies your valuation. Now, let's bring it all home with a recap and next steps so that you can start prepping today. We have covered a lot, and if your brain is spinning a little bit, that's okay. That means that you are seeing the business differently now, not just as an operator, but as a builder of transferable value. Here's what I want you to remember. Private equity diligence isn't an obstacle. It's a mirror. It reflects how well your business is run, whether you're preparing to sell, raise capital, or just scale with confidence. The best time to prep was 5 years ago. The second best time is right now. So let's recap the key moves. Understand the buyer's game. They're not just buying earnings, they're buying predictability. Master the 4 dimensions: financials, operations, legal, and strategic narrative. Avoid the founder landmines of napkin math, founder dependency, and post-LOI panic. Apply the strategic growth blueprint: clarity, cadence, conversion, and command. And prep like a pro. Mock diligence, data room, weekly finance, clean contracts, and board muscle. You don't need to do it all tomorrow, but you do need to start. Because when you show up to diligence prepared, confident, and organized, it changes the whole energy of the deal. That's when buyers lean in. They trust you, and that trust turns into terms. And if you want help with this, this is literally what we do. I've worked with founders who went from chaos to clean close in under 12 months. I've seen multipliers jump from 2 to 3 times their previous valuation, simply by systemizing the stuff that we talked about today. So if you're ready to get serious, I've got something for you. DM me the word prep or head to our website, twinflametx.com, and grab our private equity prep kit. It includes our exact diligence checklist, a data room starter map, a weekly finance agenda, and a KPI builder. All the tools that you need to get ahead before the buyers even enter the chat. So thanks for joining me on this episode of Lead, Manage, and Thrive. I'm Joe Carter. We help founders build businesses worth buying, even if they never sell. So keep building, keep leading, and when the time comes to sell, don't just survive diligence, dominate it.